Welcome to the Deep Dive. If you're joining us today, you are the learner. You're that person who doesn't just want a quick skim of the daily financial headlines. You want the actual mechanics.
Right, the real story operating behind the balance sheets.
Exactly. And today we have a highly analytical, institutional-grade breakdown lined up for you. Whether you are a FIRE investor, someone actively pursuing financial independence and retiring early, or maybe just someone looking to seriously stress test the defensive side of your portfolio, this is going to be incredibly relevant.
We are looking at a company that is quite literally a cornerstone of global healthcare, but it's also a company currently sitting at a fascinating and honestly highly debated crossroads.
Yeah, and before we even name the ticker, we need to completely shatter an old-school public misconception right out of the gate. When you hear the name Johnson & Johnson, ticker symbol Jnj, a lot of people immediately picture baby powder.
Baby powder, Band-Aids, gentle baby shampoo.
Right, and we need to clear the air for you listening right now. That era of the company is entirely over.
It is dead and gone. Ever since they spun off all those legacy consumer brands into a separate company called Kenvue, J&J fundamentally transformed. What remains today is what Wall Street calls a pure-play healthcare company.
And pure play is the key word there.
Exactly. In finance, pure play means they are no longer distracted by selling low-margin grocery store items. They are now a highly focused, high-margin powerhouse split into just two massive divisions, innovative medicine and MedTech.
To really understand what this new high-tech version of J&J looks like, we've pulled together an incredible stack of sources. We're looking at two really insightful financial YouTube analyses, one from InvestiChan and another from Stock Graphs Value.
Both excellent breakdowns.
Yeah, and to ground all of their theories, we are digging straight into the raw data from J&J's freshly released Q4 and full year 2025 earnings report, which just dropped in January 2026.
And that 2025 earnings report is exactly where the tension of our whole discussion lies today. Because when you look at this newly structured pure play data, you can build two completely opposing narratives for the future of the stock.
That's the core debate we're going to unpack. I look at these sources, and I see a deeply undervalued dividend king. I see a company generating a massive wall of free cash flow, with incredibly exciting growth in robotic surgery. So I am absolutely taking the bullish case today.
And I'll be playing the skeptic, because I'm looking at the exact same earnings report, and I'm seeing a lot of glaring red flags.
Fair enough.
I'm looking at the structural risks. While the cash flow is clearly there, the company is facing some massive legal overhangs. Specifically, those multi-billion-dollar Talc litigation provisions. Combine that with a massive revenue hole left by an impending patent cliff, and, well, we have to ask some really hard questions before anyone buys this stock at roughly $243 a share.
So if you're listening to this and wondering what to actually do with your capital, our mission by the end of this deep dive is to synthesize both sides. Is J&J at 243 a buy, a hold, or is it a classic value trap?
Let's start with your bull case. You mentioned that wall of free cash flow. When we look at the finalized 2025 numbers, what stands out to you as the primary strength?
I am looking at this sheer financial fortress they've built. The top-line sales are massive, sure, but I want to understand how they are turning those sales into such heavy profits. The data shows they pulled in $94.2 billion in full-year sales for 2025.
Which is solid.
It's a solid 6% growth from the previous year. But the net earnings, the actual bottom-line profits, skyrocketed 90.6% to $26.8 billion. How does a company this large manage to keep so much of its revenue?
It comes down to a concept called operating leverage. The InvestiChan analysis highlighted this beautifully. Operating leverage essentially measures a company's ability to squeeze more profit out of every new dollar of sales.
Because they shed the lower-margin consumer products.
Precisely. Its core operations, now complex medicines and surgical tech, command premium prices. So even when the research and development costs rise or the regulatory environments get tougher, their underlying profit engine is so ruthlessly efficient that a 6% increase in sales translates to a massive jump in actual net earnings.
The InvestiChan source actually called this free cash flow J&J's superpower. And for a FIRE investor listening right now, someone whose entire early retirement strategy relies on safe, predictable passive income that cash flows everything.
It's the lifeblood of the stock.
Right. It funds the R&D, it funds their aggressive acquisitions, and most importantly, it funds the dividend. J&J has over 60 years of consecutive dividend increases. They are absolute royalty in the dividend investing world.
That 60-year track record is exactly why institutional investors treat the stock the way they do. In times of severe market volatility, J&J often acts as what we call a bond proxy.
Let's break that term down for the learner. What makes a stock behave like a bond?
Think about a traditional government bond. You buy it because you want a safe, guaranteed yield, and you don't want the principal value jumping up and down every single day.
Right, you want stability.
Exactly. When a company has raised its dividend every single year for over 6 decades, regardless of recessions, pandemics, or market crashes, investors start to view that dividend as practically guaranteed. So when the broader tech sector or hyper-growth stocks start panicking, money flows into J&J for safety. The dividend provides strong downside protection for the stock price.
That makes perfect sense. It's a defensive anchor. And when we look at where this high-margin cash is actually being generated, the innovative medicine segment alone brought in over $60.4 billion in 2025.
The oncology numbers are what really stood out there.
Staggering growth percentages. Darzalex, their multiple myeloma drug, hit $14.3 billion. That's up 23% year over year. And another cancer treatment, Jashar VYKTI, practically doubled its revenue. It jumped nearly 96% in a single year to almost $1.9 billion.
Those growth rates are a testament to the premium pricing power of modern biotechnology. We aren't talking about generic ibuprofen here. These are incredibly complex, highly targeted, life-saving therapies.
Which means high margins.
Extremely high margins. Insurance companies and healthcare systems are willing to pay top dollar for treatments that actually extend life or offer functional cures.
And beyond the medicine, the MedTech division is pulling its weight too, with $33.8 billion in sales. I noted in the sources that they are highly anticipating the FDA submission of the OTDAVIO robotic surgical system.
Right, entering the robotics space.
The idea of competing in robotic surgery is a massive runway for future growth. You put that oncology growth together with the robotics, and you have this very steady, low volatility machine. It feels like the ultimate sleep well at night stock.
It does look incredibly stable on the surface, but we need to flip the coin now. If you're an investor looking at that $94 billion revenue number and feeling completely safe, you need a reality check. We have to address the Stelara patent cliff.
The earnings report definitely flagged Stelara. It was their blockbuster immunology drug. What is the actual damage we're looking at here?
The damage is severe. When a biologic drug like Stelara loses its patent protection, it faces brutal competition from what are called biosimilars.
How is a biosimilar different from just a standard generic drug you'd pick up at the pharmacy?
It's a great question because the mechanics really dictate the pricing. A traditional generic is an exact chemical copy of a simple pill. It's incredibly cheap to produce. But biologic drugs, like Stelara, are made from living cells. They're highly complex.
So you can't just copy-paste the formula.
Right. Competitors can't make an exact copy. They make a biosimilar, a drug that is highly similar and has no clinically meaningful differences. Because they are still complex to manufacture, biosimilars don't drop in price to pennies like regular generics do. But they are cheap enough that insurance companies will aggressively force patients to switch away from the expensive brand name.
And the sources show exactly how fast that switch happens. According to the 2025 report, Stelara's worldwide sales plummeted. They fell from $10.36 billion in 2024 down to just $6.07 billion in 2025.
That is a massive 41.3% revenue hole. Over $4 billion in high-margin revenue simply evaporated in 12 months.
Let me challenge you on that, though. A $4 billion drop sounds terrifying in isolation. But on $94 billion in total global sales, isn't that just roughly a 4% bump in the road? Why would the market panic over 4% of their top line?
Because it is not just about the top-line revenue. It's about the profit margin attached to those specific billions. Stelara was a highly mature, widely distributed drug. The research and development costs were paid off years ago. The marketing channels were established.
So it was pure profit.
Exactly. Every dollar of Stelara sold was dropping a massive percentage straight to the bottom line profit. When you lose $4 billion of your most profitable revenue, it takes a significantly larger amount of new, unproven drug sales to replace that actual profit. It means the company has to run incredibly fast just to stay in the exact same place.
They're constantly fighting against their own past success.
That is the structural reality of the pharmaceutical industry. Your growth is entirely tethered to your pipeline outpacing your patent expirations. And frankly, While Stelara is a drag on earnings, the stock graph's value analysis points out an even bigger headline risk capping the stock's valuation multiple right now.
You're talking about the litigation.
The multi-billion-dollar talc lawsuits.
Right.
J&J has been battling claims that its legacy talc-based baby powder caused cancer. They have attempted various legal maneuvers, including controversial bankruptcy filings, to resolve the claims, but the overhang remains massive.
But didn't we just establish that J&J has a superpower in its free cash flow? Even if a final global settlement costs them, say, $10 billion, they can easily afford to write that check. Why does the stock price suffer so much if the balance sheet can handle the blow?
Because of a concept called valuation compression. The stock graph's value video explains this perfectly. Markets function on predictability. Institutional investors can model cash flows, they can model drug pipelines, they can even model interest rates. What they cannot model is a courtroom.
They hate unknown timelines.
They despise unquantifiable risks. Even if J&J can afford it, the uncertainty freezes big buyers.
So even if the underlying business is making the exact same amount of money, investors just aren't willing to pay as much for a share of those earnings because the fear factor makes the stock less attractive.
That is exactly what valuation compression is. The market demands a risk premium. If you hold J&J in your retirement account right now, this litigation uncertainty is the reason your stock has likely traded sideways while the broader market indices have hit all-time highs. Until the final dollar amount and timeline of the talc settlement are completely resolved and legally sealed, large institutional buyers will keep the stock price suppressed.
Combine that litigation fear with global governments and insurers pushing really hard to lower drug costs, reducing their pricing flexibility, and suddenly that safe defensive stock feels like it carries a lot of hidden operational stress.
It does. One failed drug trial can tank market confidence.
So if you're J&J and you are staring down a multi-billion-dollar hole left by Stelara while dealing with intense legal scrutiny, you can't just cross your fingers and hope your scientists invent a miracle cure in the lab by next Tuesday. You have to take immediate action. What is their actual game plan to bridge this gap?
They use that massive free cash flow to literally buy growth. Their strategy heavily relies on aggressive M&A, mergers and acquisitions. Specifically, they focus on bolt-on acquisitions.
Let's look at the receipts from the earnings report because they have been actively shopping. They acquired a company called Halda Therapeutics, which focuses on revolutionizing next-generation oral cancer therapies. And they also bought Shockwave Medical, which sits squarely in the cardiovascular MedTech space.
The Shockwave Medical acquisition is a masterclass in this bolt-on strategy. I really want to contrast this with how other companies operate. Often you see a giant corporation try to execute a massive mega merger. They try to merge two equal-sized corporate giants.
And those almost always destroy shareholder value.
Because the corporate cultures clash. Trying to integrate two different IT systems and HR departments turns into a decade-long nightmare.
Which is precisely the opposite of what J&J does here. A bolt-on acquisition means J&J finds a smaller, highly innovative company like Shockwave that has already proven its technology works. J&J buys them, takes that proven product, and immediately plugs it into their own massive existing global army of medical sales reps.
They don't have to reinvent the wheel, they just buy the wheel and put it on their hyper-efficient distribution machine. It creates instant scale and instant top-line growth.
And we saw this play out on the pharmaceutical side, too, in 2025.
Yes, the acquisition of intracellular therapies.
Right. They brought in a drug called Caplyta, which treats major depressive disorder. In 2025 alone, Caplyta generated $700 million in U.S. sales. They're taking their massive cash reserve and strategically plugging these Stelara-sized revenue holes with proven high-growth assets that are already approved and selling.
What is equally important to notice is what J&J is actively choosing not to do. The earnings report also highlighted their announced intent to separate and spin off their orthopedics business.
Wait, why would they get rid of an established medical device business? People are always going to need knee and hip replacements.
It comes back to defending their profit margins. Orthopedics is a very mature, slower growth, and highly competitive market. The profit margins there are much lower compared to something like robotic surgery or complex oncology drugs.
So they are curating the company.
Yes. By spinning off the slower parts of the business and bolting on the fast-growing parts, they are showing incredible financial discipline. They are only keeping the absolute highest margin assets.
It's the ultimate margin defense. By avoiding the catastrophic integration risks of mega mergers and shedding the lower-tier divisions, J&J maintains top-tier operating margins and cost efficiency. And that relentless focus on efficiency is what protects that sacred dividend, even when underlying drug sales fluctuate. So we have the unstoppable free cash flow and the highly disciplined M&A strategy on one side, and on the other, we have the terrifying patent cliffs and the looming unquantifiable cloud of talc litigation. If you are listening to this right now and you are trying to manage your own of-fire portfolio, what is the actual play here? Let's look at how the professional analysts are pricing this tension.
The stock graph's value analysis provided a really helpful snapshot of the current Wall Street consensus on J&J. Out of the major analysts covering the stock, we are currently looking at 5 strong buys, 9 buys, 10 holds, 0 sells, and exactly 1 strong sell.
It's a very balanced, clearly cautious consensus. Let's unpack the psychology behind these ratings. Why are there so many analysts sitting in the hold camp? 10 analysts are effectively telling their clients, just wait.
That large group of holds reflects strict valuation discipline. These analysts are acknowledging the quality of the underlying business. They see the pure play margins, they see the cash flow, but they are demanding total clarity on the talc litigation before they are willing to recommend paying a premium for the stock.
They refuse to buy into unquantifiable legal uncertainty.
Exactly. They want the court cases closed before committing new capital.
But then you have 14 analysts sitting in the buy or strong buy camp.
Yeah.
What are they seeing that the hold group is ignoring?
The buys are looking past the current headlines. They believe in the long-term compounding pipeline optionality of the business. They see the MedTech recovery, especially the potential of the OTT AVA robotics submission, and they view the $243 price point as a very fair entry point for a world-class compounder.
They believe the market is over-penalizing the stock for the litigation.
Right. They see it as a buying opportunity based on undeniable dividend safety.
And then we have to talk about the lone wolf, the single strong sell rating.
That single rating represents the pure, unadulterated bear case. This analyst believes that the combination of the legal risks and the global structural pressures to lower drug prices will act as a permanent ceiling on the stock. In their view, J&J is destined to be a permanent value trap.
A value trap being a stock that looks cheap on paper and pays a nice dividend, but the underlying business is eroding so much that the stock price never actually goes up. You just end up losing money slowly.
Correct. The bear thesis is that the fundamental headwinds in the pharma industry are just too strong for J&J to overcome, no matter how much cash they generate.
So synthesizing everything we've pulled from the 2025 earnings and these analyses, where do we land? Is this a buy, a hold, or a value trap?
If we look at the totality of the sources, the financial stability highlighted by InvestiChan, the valuation dynamics from StockGraph's value, and the raw 2025 data, I think there is a definitive pragmatic middle ground for you as the listener.
First of all, we have to be honest about what J&J is not. It is not an explosive growth rocket. If you are an investor looking for pure adrenaline or you want a stock that is going to double your money in the next 12 months, look elsewhere.
J&J will absolutely disappoint you on that front.
However, if you are a long-term fire investor, the thesis is fundamentally different. Your goal is portfolio survival and steady income. The fundamentals of the innovative medicine and medtech segments are remarkably strong. The cash flow is elite.
If, and this is the critical, if the litigation uncertainty is cleanly resolved in the near future, this stock has the underlying strength to modestly re-rate upward.
It is a defensive anchor. It acts as a bond proxy that pays you a very handsome, historically safe dividend while you wait for that legal uncertainty to clear. At roughly $243 a share, if your primary goal is stability and compounding passive income over rapid capital appreciation, the data suggests it leans much closer to a solid hold or a cautious buy rather than a value trap.
It's a stock that lets you sleep well at night, provided you fully understand the legal risks you are sleeping next to.
That is the perfect way to frame it. But before we wrap up today's deep dive, I want to leave you with a final, provocative thought to mull over on your own regarding the wider healthcare industry. We know that shifting demographics and an aging global population are going to drastically increase the baseline demand for healthcare over the next 2 decades. The pie of available patients is only getting bigger.
That is an undeniable demographic tailwind.
But as we unpack today, J&J relies incredibly heavily on its free cash flow to execute M&A. They are literally buying their way out of patent cliffs like Stelara by purchasing smaller, innovative companies. So the question you have to ask yourself looking forward is there a limit to this strategy?
Right. How long can a massive pharmaceutical company simply purchase external innovation before the rising structural costs of the industry finally catch up to them?
Exactly. And with the increasing premium placed on successful biotech startups, can a giant just buy growth forever? Or does the model eventually break?
That is the multi-billion-dollar question for the next decade of healthcare investing.
It really is. Thank you so much for joining us on this deep dive today. Keep questioning the headlines, keep digging into the mechanics behind the balance sheets, and above all, stay curious.